Good morning and welcome back to Morning Markets from True Potential. Paul Durrans, Investment Director. We'll start this week by just reflecting on equity market returns. Last week, on Friday, US equity markets finished the day in positive territory, up 0.2% after showing initial weakness through the course of the day. When we look at the individual sectors, energy was a strong contributor, up 4% on Friday, and that was really helped by a higher oil price, which was up over 2%, up to $87 a barrel, and that's for Brent oil. And that was just in response after Russia announced on Friday that they were going to cut oil supply by 500,000 barrels a day, and that's going to kick in on March. That's in response to the Western nations' price cap set on oil, Russian oil. When we look at the other sectors, healthcare, utilities performed well. They're defensive sectors, whereas technology and consumer discretionary sectors underperformed. Looking at the course of the week, global equities and fixed income markets saw declines, but we have to remember we've been in a period of very strong returns for both equities and bonds through the course of this year. Last week we saw some weakness, and that was just in response to investors still a bit concerned about the trajectory of inflation going forward. The US labour market continues to be very, very strong, very good for the US economy and future consumption, but that does mean that it can put upward pressure on inflation going forward. We heard from various Federal Reserve members whose job it is to set interest rate level. They talked about their concerns about just the strength of the US labour market and the impact that's having on inflation, and in their perspective, they're not done on where interest rates should be. They're expecting or guiding that interest rates need to go higher in the future. In terms of looking to the week ahead, tomorrow all eyes will be on US inflation. Really important because it determines whether interest rates are set at the right level, and it impacts both businesses and households. What we're expecting is inflation to fall from 6.5% to 6.2% on an annual basis. When we look on a month-on-month basis, we're expecting it to increase from 0.1% in December up to 0.5% in January. A number of reasons why. Firstly, gasoline prices have been increasing throughout January. We also get businesses typically at the start of the year reset their price levels for the year ahead. So you can often get a lot of volatility in the estimates, 0.5 expected, so we won't be surprised to see a bit of deviation around that. It's also important to look at inflation and strip out those more volatile components such as energy, such as food prices, and look at what is known as core inflation. And that's more directly impacted by interest rates. When we look at the numbers there, we're expecting inflation to fall from 5.7 to 5.4%. But all eyes will be on this report, be the main event this week, so please stay tuned for that. On Wednesday, we'll get UK inflation. That's expected to fall still at very high levels at 10.5%, expected to decline to 10.2%, but it won't be until May when we expect inflation really to start to drop off noticeably as those base effects start to kick in. Elsewhere, what we'll be keeping an eye out for is in the US, industrial production and retail sales, and for the UK, we'll get employment report and also retail sales. For Japan, we'll get their latest GDP figures, which will give us an up-to-date measure of their economy. So lots of data this week. Please stay tuned and we'll keep you up to date.
If you're interested in taking your investing to the next level or would like to know more about the options available to you when you retire, then download our free guides to ISAs and pensions. These are available in the video description below.